Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, let's talk about something that happens all the time. Picture this. Your spouse gets an amazing job offer in another state, but you're not moving. It's a super exciting time for sure, but it also opens up this huge, and I mean huge, financial question that most people don't think about until it's too late. Today, we're going to break down exactly how to handle that. So what if I told you there's a way to legally shield a massive part of your household income from state taxes? For any couple trying to manage a life in two different states, getting this right isn't just a nice little tip. It's a total game changer for your finances. Okay, so here's our game plan. We're going to tackle this in 5 simple steps. We'll start with the problem, then get into the weeds on the rules, find the legal strategy that works, and then I'll lay out the exact filing plan to pull it all off. So, let's dive into our real-world scenario here. We've got a married couple. The wife, she's staying in California. She lives there, she works there. Her husband, though, just landed a fantastic new job up in Washington State, so he's packing his bags and heading north. And right away, here is the fundamental issue. California, as you probably know, has some of the highest state income taxes in the entire U.S. And Washington, it has 0, none. That massive difference is exactly why you have to be so smart about this. So that brings us to the big question, right? How in the world do they legally stop California from taking a slice of the husband's new salary, a salary that's being earned 100% in Washington, a state with no income tax? To figure that out, we've got to understand the main opponent in this story, and that is California's incredibly powerful tax authority. It all comes down to one little word: residency. Okay, now this is where it gets really important. If you are a California resident, the state can tax your income from anywhere in the world. But if you're a non-resident, California can only touch the money you make from California sources. This single distinction, it's the key to everything. So the strategy, the entire goal really is simple. We have to successfully change the husband's legal status from a California resident to a non-resident. If we can pull that off, his Washington salary is untouchable. But, of course, there's a catch. California is not just going to take your word for it. The state's tax board is, let's say, famously skeptical when people suddenly claim they've left, especially when their spouse is still living there. And you can kind of see their point. They're trying to protect their tax dollars. They know that people might try to claim they're a non-resident for a year just to avoid a big tax bill on a bonus or a new job. So yeah, they look at these situations very closely. At the end of the day, what the state is really asking is this: are you just doing this for a temporary tax dodge, or have you genuinely moved for the long haul? Proving that can be messy and subjective unless you know about a very specific rule. And here it is. This is the secret weapon. There's a special provision in the tax code called the safe harbor rule. Think of it like a clear black and white test that proves you're a non-resident. No questions asked. So here's what it says, basically. If you leave California for a job, and that job comes with a contract for a specific amount of time, the state will just automatically consider you a non-resident for that period. It takes all the guesswork right out of the equation. So what's the magic number? It's 18 months. The employment contract has to be for at least 18 months. That right there is the most important detail in this entire strategy. So let's run our guy through the checklist. Is the move for a new job? Check. Is the job outside California? Check. And let's say his contract is for 2 years, well over 18 months. Check. And just like that, boom, he officially qualifies as a California non-resident. Okay, so we did it. The husband is now a California non-resident. We are so close. The last step, the final piece of the puzzle, is filing their taxes the right way to actually lock in those savings. Now, this is where you have to throw out what you normally know about taxes. For most married couples, filing jointly is the best way to go, but not here. No way. In this case, if they filed jointly, California lumps all their income together and taxes it. But if they file separately, the husband's income is treated as its own thing. By filing as married filing separately, the wife files her California income as a resident, and the husband files his Washington income as a non-resident with 0 income from California sources. And the result? His entire salary is legally, totally protected from California state tax. It's a huge win. So the big takeaway here is that state lines are also tax lines. Understanding these residency rules isn't just some boring paperwork detail, it's a massive financial strategy. And it leaves you with one last question to think about. When life takes you to a new address, have you thought about what that new zip code really means for your wallet?